Hi, everyone. Thanks for joining us today. I'm Brad Town, and I'm here with my colleague Claire Durand from the JP Morgan Private Bank South Bay team.
Yeah, we're very excited to partner with Palos Verdes Peninsula Land Conservancy and to explain some of the important recent changes that may affect your charitable giving strategies to this great organization as well as to others.
So, in this session, we'll walk you through some important updates on charitable deduction limits and gifting strategies, especially in the light of the new One Big Beautiful Bill Act, or OBBBA. Our goal is to help you understand what's about to change in 2026 and what strategies you can use now as a donor to maximize your philanthropic impact and enhance support to the organizations you care about.
Yeah.
So, Claire, these changes are pretty significant, right? As we look ahead, it's clear that understanding them now can help donors make smart decisions and preserve more of their charitable capital.
Absolutely, Brad. This new law introduces some major shifts starting in 2026. So 2025 can be a critical year for both action as well as planning. And so the proper timing and strategy can make a significant difference to the value of your charitable gifts.
So let's break down the three major updates then.
Mhm.
First, charitable contributions must now exceed 0.5% of your adjusted gross income, or AGI, to be deductible. Second, for high income taxpayers, there will be a cap on the value of itemized deductions, so the full tax benefit may not be available. And third, the smaller annual gifts may no longer qualify for a tax benefit, which could impact donors who give modest amounts each year. So, Claire, if someone typically gives some amount every year, for example, during an annual appeal, does that mean they might not get a deduction or the full deduction for those gifts?
Exactly. So, for example, if your adjusted gross income or AGI is $1 million, only charitable gifts that exceed that threshold of $5,000 would be deductible next year. And for those that are in that top tax bracket, the value of those itemized deductions will be further reduced by an additional 5.4%. So, that can be a pretty significant change.
Yes, that's a big shift, especially for high earners and those who regularly contribute to annual campaigns. What does this mean for donors now, still in the last few weeks of 2025?
So that's a good question because 2025 can be a unique window, but the timing is really short here. So, what we look at is doing some planned giving before the end of the year if you want to maximize those deductions under the current more generous tax rules.
So, if you're considering a significant gift or even a series of gifts over the next few years, then acting in 2025 could still be a smart move.
Yeah, that's right. So if you act in 2025, you can deduct the full amount if you itemize your deductions. And you don't have to worry about that floor or the haircut. And even if you don't have time to plan and act this year, there are certain things that you can think about for 2026 and beyond. And so what we're really seeing is a shift in the way that donors are thinking about gifts over multiple years.
Okay. So, for this year and next, what specific strategies should donors be thinking about to help preserve the full value of their philanthropy and the capital they can give?
I really think that there's three main approaches. And so the first one is bunching. When you
Okay.
think about bunching gifts, what that means is that instead of spreading it out over, smaller amounts over multiple years, you consider consolidating them into a single year. And that way the gift exceeds that 0.5% AGI floor and you maximize your deduction. Another way, the second thing is we can look at gifting appreciated assets. So when you're donating appreciated assets and giving those long-term appreciated assets directly to the charity, you can get a deduction for the fair market value and you eliminate the capital gains tax. That makes your gift a lot more tax efficient. The third thing, for some donors, we're recommending a donor advised fund or a DAF. And that DAF, donor advised fund, allows you to make a large charitable gift now, and then you can distribute out to charity over time, especially for those that have multiple charities that they want to gift to, or they're not certain who those charities would be. And this helps you lock in today's current tax deduction before those new limits apply.
Okay, Claire. So I think these are three great points on bunching gifts, donating appreciated assets, and potentially using a DAF. I do want to dig a bit into the appreciated stock specifically as an example. So If a donor has appreciated stock, why might it make sense to donate that instead of cash?
Yeah. Oh, donating appreciated stock can be a win-win because you'll get that deduction for the full market value, but you're also not having to pay the capital gains tax, which would happen if you were to sell the security. So gifting directly to the charity receives those assets and they don't have a tax consequence when they end up converting the security over into cash or folding it into their current portfolio, which would be targeted to their goals. Also, if your intended charity isn't set up to receive those appreciated securities, that way you could utilize a donor advised fund as a great intermediate step.
Okay.
Yeah.
So let's walk through a quick example. Then suppose you have $500,000 in adjusted gross income and
Mhm.
plan to give $5,000 cash to the Land Conservancy each year. What might the deductibility look like in this case?
Great example. So in 2025, for the full $5,000 to be deductible, if you itemize, that's plenty great. But in 2026, what's going to end up happening for that $500,000 adjusted gross income, you'll only be able to deduct the excess over that 0.5% of AGI or the $2,500. So that kind of ends up even being a little bit less for taxpayers in the highest tax bracket because they'll be hit by that 5.4% additional haircut. So it can be really smart to consider making those gifts in 2025. And for those that don't itemize, actually starting in 2026, the One Big Beautiful Bill does allow for single filers to get the deduction of up to $1,000 for cash gifts and $2,000 for filers that are married filing jointly.
Okay, so either this year or next, then bunching those gifts um, either directly to an organization you care about or into a donor advised fund could mean more tax savings.
Exactly right. Yeah.
Okay. Well, thanks, Claire, for breaking all these changes down for us. I think you've made it clear that, again, 2025 is a pivotal year to plan and act. And in the coming years, gifting strategies will change.
Yes, and we do encourage you to consult with your tax advisor to make sure that these strategies can be tailored to fit your goals. And the right approach really can make a big difference, meaningful difference to both you as well as the organizations you support.
And I'll point out specifically that the Palos Verdes Peninsula Land Conservancy, today's donations will help expand existing nature education programs and support the restoration of lands for habitat and for wildfire resilience right here at home. And as I understand, there's currently a dollar for dollar match provided by a very generous anonymous donor for gifts made before the end of 2025.
Wonderful. And sounds like that donor already knows the value of doing some great tax planning around charitable gifts.
Right. So to all those who dialed in, thanks again for joining us. If you have any questions or want to discuss your specific situation, Claire and I are here to help you navigate these changes. Our thanks to the Land Conservancy for helping us make sure you can maximize your impact and support this organization now and for years to come. Take care.